News from May's FOMC. The Fed raises U.S. rates by a quarter point, signaling possible pause. The Federal Reserve raised interest rates by a quarter percentage point and hinted it may be the final move in the most aggressive tightening campaign since the 1980s as economic risks mount. The committee will closely monitor incoming information and assess the implications for monetary policy, the Federal Open Market Committee said in a statement Wednesday. It omitted a line from its previous statement in March that said the committee anticipates that some additional policy firming may be appropriate. Federal Reserve Chairman Jerome Powell speaks about the decision by the Fed's policy-setting Federal Open Market Committee to raise its benchmark interest rate by a quarter of a percentage point. That's a meaningful change that we're no longer saying that we anticipate further increases, Chair Jerome Powell said at a press conference after the decision, when asked whether the statement is a signal that officials are prepared to pause rate increases in June. So we'll be driven by incoming data, meeting by meeting, and we'll approach that question at the June meeting. The increase lifted the Fed's benchmark federal funds rate to a target range of 5% to 5.25%, the highest level since 2007, up from nearly zero early last year. Whether that rate will prove to be high enough to bring inflation back to the Fed's 2% target will be an ongoing assessment based on incoming data, Powell said, adding later that Fed officials' outlook for inflation does not support rate cuts. Powell said bank conditions had broadly improved since early March, but said the strains in the sector appear to be resulting in even tighter credit conditions for households and businesses, following a tightening in credit over the past year. Powell said Wednesday it's possible the U.S. could experience what he hopes would be a mild recession, but the case of avoiding a recession is in my view more likely than that of having a recession. Tuesday also saw the release of a monthly Labor Department report showing job openings fell and layoffs jumped in March, in a sign that the job market is finally beginning to feel the impact of monetary tightening. Still, prospects of rising unemployment are ringing alarm bells in Washington as the 2024 presidential election campaign shifts into gear. A group of U.S. senators led by Elizabeth Warren and Bernie Sanders published a letter to Powell Monday, urging him to cease rate hikes. While the Fed may be finished raising rates, Powell and his colleagues have pledged to keep them elevated for a time to make sure the central bank's preferred measure of inflation, down from last year's peak of 7% to 4.2% as of March, continues receding toward the 2% target. Projections published after the March FOMC meeting showed officials were nearly unanimous in expecting it would be appropriate to maintain the federal funds rate above 5% through the end of 2023. Prices of interest rate futures have long signaled an expectation in markets that the Fed would pivot to rate cuts in coming months.